Hey everybody, it's Wednesday, September 3rd, 2025. We'll start with our headline, Weak Job Openings. Bad news is good news. The number of job openings was expected to be higher. We also had some downward revisions for today's report, but not such a bad number that we are necessarily falling off of a cliff here. In fact, we are obviously going pretty much sideways since the summer of 2024 in this metric. The lower than expected number allowed the September Fed funds futures to show that we are having now a 92% probability of a cut in September, and in October a 53%. So it was before we were thinking not the second cut for through the end of the year until December, and now it's more confident that it's going to be a little earlier. The news on Google did send stocks higher today, but behind the curtain here, we also have credit spreads tightening again. So I think the larger behind the curtain picture here is Mr. Market said a little bit of risk on today because of this jobs report. There were a lot of interesting things on the charts today, so stick around for those before we get there. Community topics. What moves, if any, did you make? Robschild buys TND stock. Just kidding. It's TLF stock. TLF represents the company Tandy Leather. They sell leather crafting goods for people that want to make their own purses, belts, and wallets. And I just caught this now at the top of their website. It currently says orders are taking longer to ship than usual. Thank you for their patience. Business must be heating up. But that's not why I'm interested in buying this stock and why I bought it today. So let's go through some of the financials. First, we're going to take a quick look at the earnings per share. How much money does this company make per share? And while we did have some negative earnings in 2019 into 2020, the rest of its earnings record is positive. So not stellar, but not terrible. I'll also say I like seeing dividends. Whenever a company is paying any kind of dividends, that tells me that management actually cares about their shareholders. Definitely not a dividend king, but they pay dividends when they can. For a publicly traded company, its market cap is very, very small at only $24.5 million. And where the real value lies is all in the balance sheet. We can take a look at, let's make these a little smaller really quick. Simply taking a look at current assets, in other words, cash and inventory, essentially, is at around 55 million, and their total liabilities is only 20 million, or 19 million. By that metric alone, this company is an absolute gold mine in my book. Remember, only current assets alone, so just cash and inventory, essentially, is worth 35 million more over the entire liability. So all of the money that they owe, they could pay that back and you'd still have $35 million left for the shareholders. And that doesn't even include any of the non-current assets, and their net PPE is another $20 million. And when we open that up, we can see they have accumulated depreciation. I like to see that number. Now, retailers sometimes will, upscale the value of their inventories to be more than what they are really worth necessarily. But when you combine the amount of current assets plus the non-current assets against its total liabilities, this is clearly worth way more than $25 million as it's being sold for right now on the market. Right now, the current stock price is around $3 a share. Now, to take a very, very conservative selling price, let's take out 15 million from the inventory value, and let's cut the net PPE in half. So that takes out 15, and then take out another 10. That takes out 25. You're still left with $50 million worth of assets, currently at a market cap at 25. I think that this going to $6 a share, in other words, doubling from this point, is a downhill battle in my book. Did you buy anything? Did you sell anything? Let us know in the community in the comment section below. Coming up tomorrow, we have the ISM, one of the bigger reports of the week. We also have the weekly jobless claims. Remember that continuing claims can't just keep creeping higher and higher forever without a recession. And then the real big report of the week is Friday, the employment report. And as always, we have, I'm sure there will have more tariff updates coming as always. Thank you for watching, liking, subscribing, commenting, and supporting Robschild. No changes to the daily reminders macro view. See my website to read them. And the Robschild portfolio, like I just talked about, I added TLF stock, and I don't have that on the website yet. I will update it as soon as I can. Also, no changes to the crystal ball ratings. On to the chart, starting with the SPX, the S&P 500. We rose by 0.5%, notably above this yellow trend line that we have been kind of having a lot of support on. So we're back above that line from a trend line analysis. The advanced decline line, however, ticked down, suggesting that it was really the bigger names that carried the stock market higher. However, risk appetite grew, like I showed earlier, with credit spreads slightly tightening. Remember, we are still below 3%. I don't think credit spreads will stay this tight forever. But anyway, the triple Qs also went up 0.8%. A lot of this was obviously the Google situation, which I'm sure you've been reading about in the news. Next, SMH, we are still in this head and shoulders top pattern. We went completely flat today in the semiconductors, interestingly. Next, we have TNX, the 10-year Treasury note yield, dropped pretty dramatically today. I remember yesterday I was surprised that because of the news on tariffs potentially being blocked, that I was expecting the 10-year note yield to go way higher than it did. It did jump 5 basis points, but then we lost all of that and more today, dropping 7 basis points. I found it notable that the MOVE index gained momentum and sort of breaking out of this pattern to the downside. Remember this, the MOVE index is the volatility of bonds. So when the bond market starts sniffing out larger moves in bonds, this goes up, and that's what's happening while the long duration treasuries are going up and yields are going down. So will this continue? Will we see bonds continue to rally along with the MOVE index popping, as it sometimes can do? I don't know. We'll see. Crude oil made an interesting move. I noted yesterday we broke above that $65 a barrel marker that I think has been a pretty big psychological level for a long time now. We went down pretty strongly. It looks like we're almost engulfing the last 2 trading days, so have to keep an eye on it. Next, copper with a PhD in economics, dropping very slightly today, still in my book in a consolidation. You know, this is starting to look more and more clear, like, I mean, not more and more clear. It's, well, yeah, more and more clear that we are in this rising channel here. Typically, rising channels actually break to the downside. So, yeah, we'll see what happens there. I want to also bring up silver. Silver, looking like the sky is the limit. You know, like they say, blue skies ahead. And same thing in gold. Gold moved quite a bit higher. We hit intraday, middle of the day, 35.76 on gold. My understanding is this is partly to do with central banks being big buyers of gold. They just buy no matter what the price is, day after day, week after week, whatever their program is. So as long as they continue to do that, I guess gold can keep grinding higher. The sky looks like the limit at this time. I know some people are calling out, you know, $4,000 to $5,000 an ounce at this point. I think gold is very, very clearly in a bubble. I won't be participating in this run, but it is fascinating. Next up, DXY, the dollar index. I want to point something out. This is an important chart to take a look at. We have been going sideways for quite a while now, and I've been talking about it potentially building a bottom here and that there's maybe more strength than other people think, but I'm starting to wonder if that might not be the case, only because DXY is largely priced against the euro, and that includes German bonds. And one thing that happens pretty consistently is when you have the U.S. 10-year Treasury bond yield dropping faster than the German 10-year bond, this chart goes down, and typically the dollar follows. In this chart, I currently have the yellow line as the dollar. If you scroll out through history, there's a very, very strong correlation between the yield differential and the DXY index, which follows it like pretty much like clockwork. When the 10-year minus German 10-year goes up, the dollar follows. When it drops, the dollar follows. Very, very consistently. And very recently, throughout this period, I'm going to say that as the dollar appears to be going sideways, especially at this tail end here. Let me scroll in. Sorry about this. You have the dollar basically having higher lows and going completely sideways. This is really falling the 10-year minus German 10-year yields. So this could be a sign, in other words, that the dollar is about to actually start falling now. Last chart of the day, the Fear and Greed Index on CNN Business finally dropped neutral. We've been in greed mode for quite a while. The Fear and Greed Index for September, this has finally dropped to a neutral stance. Main thing of the day for me was lower yields made the markets happy. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.